Will Face by Chris, Kevin, Patrick, Zig. I'd also like to welcome our trading warrior brothers and sisters watching us at investing.com this morning. How's everyone doing? Okay, let's have a great Thursday. There are a few market items I want to cover here. So yesterday we were talking about the tax plan being announced, and I said it could be a buy the rumor, sell the fact. To me, this was a very classic stop hunt. Okay, so the stop hunt took out all these people who thought they had a top down here and no follow through. And the reason I bring it up is this is a 4 hour and it looks like we could roll over. Now Blake's looking at 24.90 as being a real important pivot. It's Thursday, there's still plenty of time to close under 24.90, which would take us to 70. And more importantly, when you look at the macro of it, take a look at the weekly, and this could turn into somewhat of a significant week. And the reason is we now have an outside week. We've taken out last week's high, last week's low. We're about unchanged on the week. The 2-week off number comes in at 24.98. So we could have a 2-week reversal happening here. So the way I would play it is finesse your entry, and you're wrong over the stop hunt yesterday. So stop hunts, this is a lot of the things that I teach. Stop hunts, you wait for where everyone has put their stops, and people go, Dale, well, how do you know where the stops are? And it's obvious. All you have to do is say to yourself, if I were short, where would I put my buy stop? And you know what? It's usually over an obvious swing high, and that's where everyone's stops are. Okay, so they took out the buy stops. My contention is there's a good possibility we take out the sell stops, people that bought the market at this low by Friday. If we do, it's going to be a very negative week. Okay, and if that's the case, yesterday I talked about the yen. Yesterday in the Jumbotron room, someone asked me, Dale, what would be your preferred short of any currency? Okay, guys in the room, you're on the Jumbotron right now. How are you? So I said it would be the yen. We had glaring divergence in the yen on the 4 hour, not the 1. Sometimes the 4 is good enough, as you can see. We're not confirming. It's my contention that we could have, if I'm right about the S&Ps, have a little risk off happening that could take the yen back. I'm not talking about a crash in the yen, but we start getting back to 112. That opens up the door for 110.50, which will just be a normal correction in the market. Everyone with me? I'll take a look at that in a minute. But one thing first, guys, I do have some unfinished business. So I don't know, you know, I'm in front and everyone knows me, and Steve talks every day, and Blake, and Nick's going to be with us. But behind the scenes, we have a very valuable team member, and I missed his birthday yesterday. And it's tradition in any trading community I've been in to sing happy birthday. You're on the other side, you're still looking? Okay, Luca. That has me a little concerned, but we'll see. We'll see if 1425 happens before 1050. But this goes out to you, Valu, for all the great work you do behind the scenes and streaming our work out to the world and editing our videos. Happy birthday, buddy. Happy birthday to you. Happy birthday to you. Happy birthday, dear Baloo. Happy birthday to you too, Sandeep Singh Man. So Baloo, you and Sandeep are, have the same birthday. My birthday hope for you is that this is your best year ever in all ways. Okay. So Luke is looking for 114. We'll see what happens. We have a couple of days left. So also I want to point out, and Nick's here, so I just want to point out that Alexandros Fontes. Hey, Nick. he pointed out that 117 was cloud support. He doubted if it was going to take it out. We'll see. I still don't have anything that tells me to rush out and buy it, but if you were bearish, it was a great cover spot. So he showed the cloud, the Ichimoku cloud, coming into cloud support at 117, so far a bounce. And then I just want to wrap it up with Euro Yen, and then I want to know who else I'm on the opposite side of the market with.
Nick is actually, I just heard her pop in, and good morning, Dale.
Hi, how are you, Blake?
Good. Go ahead and cover what you were going to cover.
All right. Well, I still think that a couple days ago talked about buying for a counter trend move at least. Rega was very bullish. The yen crosses, and yesterday I said cover. I think anywhere between here and 133 you could short it for another break. So I don't think this is the bottom in Euro Yen. So, especially if the S&Ps do come off and break and the yen comes off, I think Euro Yen, that's a pretty weak recovery. To me, it looks corrective. So I still think there's a short there. And Nick, I'd be happy to hand it over to you. It's great to hear your voice. Good to have you with us.
Yeah, I kind of agree with you. It's weird because I look at that Euro Yen and I go, oh, it really needs another leg lower for an ABC correction. But where is it going to come from? Is it going to be the dollar yen, or is it going to be like the euro that's going to keep going here,
Yeah.
Or both.
I'm kind of thinking it might be yen driven. That's just a guess. But
yeah, definitely, I agree.
So, I know you're very bullish yen. Can you make the case for a pullback to 1050, Nick? And I'm handing you the screen. So
yeah, definitely.
Okay, well, that gives me more confidence. So, that's what's great about ForexAnalytix. I know, guys, listen, it's Thursday, and Monday's the last day of the sale.
What can you see on my screen, Dale?
I see a blue screen right now, Nick. But
okay, hold on.
So you may want to click that button and get signed up before the great prices go away. Those of you at investing.com.
Now we see a Fibonacci black. Well, it was a black screen. Okay, now we got your dollar yen.
Yeah, US dollar yen here, Nick.
Okay, so here's my dollar yen. I was quite bullish. Here we are with above the 200-day moving average, and this is my day chart. Some of these.
Losing your audio bit, Nick.
Okay, sorry about that.
It's okay.
Yeah. Okay, so for me, although we're above this 200 moving average and we've had a really cool bullish run, there's a couple of reasons why we might stop here. The first one is it's the 50% from the high to the low. So the high in December to the low that we made in September, this is the 50% level, and it's also the 78.6 of this last swing lower. So there's a couple, I'm just going to tie these up. So there's a couple of Fibonacci reasons, and there's also this trend line. So I think that it's just one of those levels where we're going to come back a bit and retest support and see if we're going to continue higher or not. And a 50% is usually corrective if we reverse here. So we could come all the way back to 50% of this swing higher as well. So that's what I'm looking for in the dollar.
If we ever take out 107, Nick, I look at your chart and it brings me back to Edwards and McGee. And if I've ever seen the potential for a descending triangle, this is it. I know we had a little B, but of course it's not a descending triangle until it takes out 108 again. But it kind of has that look to me.
It definitely does. And if we make an ABC correction in this dollar yen from the highs last December, then we're going to come to 104.20. That, interestingly, is, that would be a Gartley pattern there. So that would be quite nice, a bullish Gartley pattern down there.
Oh, okay. So, and that might tie in with a little bit of a pullback in equities and some of the yen crosses.
Yeah.
Okay. Because all the yen looks terrible still.
I know, and it's weird because the bonds look like hell, don't they? But maybe the bonds are at support. So
yeah,
I completely agree with you.
So besides the yen,
what does that mean for gold and silver then? This is interesting because today, the same thing, 50%. So the dollar yen is at a big 50%. This is a 4-hour of gold. We're at 50% of the rally from the low in July. So this is quite an interesting level at 1280. We had a little bit of a poke below it, but potentially we could see a bit of a rally from here. I think if we connect the trend line and we get back above this and we get back above the 38.2, which is 1299, 1300, I think back above 1300, gold's made a bit of a bottom too. So
Great
that
look.
would be a nice long trade.
And for people that don't know, they've been running counter-cyclical to each other. So a strong yen, which is a weak US dollar yen, usually equals stronger gold prices. And strong and stronger bond prices. So
exactly. So I'm going to show you the 10-year note because this is quite interesting. Fib support in the US 10-year. I've been watching this before I did an update because this is the 886 fib of the last swing lower. By that I mean the swing lower from the July low as well. So we're at the 886 fib retracement from that, and we're at a big 50% fib too. In this 10-year, so we're at the 50% back of the entire rally, which is from December 2016 as well. So 50% back in dollar yen, 50% in the US 10-year. I need to go up to a daily to show you this better. Excuse me while I just change time frames here. So yeah, from this low to the high that we made in July, exactly the same as dollar yen, we're at the 50%. This trend line I've drawn here, it's not a fantasy trend line. I've got 3 touches on the upper trend. This is a trick. You won't find this in a technical analysis book. But if you connect the highs and you've got 3 touches on the highs, very often, if you're looking for where a breakdown, because if you draw this, say, as a rising wedge, and you're looking for this where this might find support, then if you in TradingView you just right click it and clone it, so then you get a trend line with the same angle, and you project it from the low, and then you see if we're in an equal channel, then that is where I usually look for it to find some support.
That's a great trick, and I just learned that trick doing it. Because I would eyeball it. I didn't use the tool, but I would always, draw return lines and then look for trend lines. So, that's a
well, I think if traders using MetaTrader 4, I think you can draw a parallel. You can do a parallel channel. It's quite easy to do, but in TradingView, you just right-click it and clone, and it'll give you this. I'll show you again, clone, and you've got the same angle. You can move it.
Nice.
So then, if you want to see like from other ones, you can. Anyway.
Speed lines.
Right.
You love these charts, Nick.
So I'm seeing the same thing. Like
Nick, you kind of geeked out on us, but that's cool. That's a cool.
Okay. So that's dollar yen at a big 50 and a big fib confluence. That's gold at a big fib confluence, and now we've got the US 10-year at a big fib confluence. So let's see. And then there's your false, run the stops in stocks. So maybe we do head lower here.
That was a pretty classic stop hunt yesterday. On the and it was a buy the rumor sell the fact on the announcement of the proposed tax plan. So anything else on the radar? Like crypto?
So I will talk about crypto in a minute, but I will say the binge, the binge has been equally bearish, and I've drawn this as, it's very hard how to draw this as a triangle or a wedge, but classic trend, a lower low, higher high. Here we are testing these prior lows in the binge that were also a messy bottom back here. So, we could see the same thing in the binge and a rally from here as well. So that's what I'm looking at them. So gold, yen, everything's saying the same thing, and I completely agree about your view on euro yen and how weak it looks. And CAD yen wasn't that ugly yesterday.
Wasn't that a pit by Grega? I think CAD yen this week, Blake.
Well, he was long, and I went short actually on a shooting star yesterday. So.
Okay, because I remember going woot on Skype. So Interesting. So here we're going to cryptos now.
I'm just going to bring up a Bitcoin and an Ethereum chart because.
You know, Nick, I want to ask you, I interviewed Valentin Schmidt, and I noticed you retweeted the interview. He said he was more worried about the hard fork than China clamping down or banning Bitcoin. You know, do you feel the same way? I mean, China's tried to artificially control markets before and really not that successfully. So could it be a bullish omen that China's cracking down?
Yeah, you know, well, I think that most of what China's been trying to do is control their currency. This is, I don't think that they want to shut down Bitcoin, but they definitely want to control it. And I think that this is what this has been about more than anything else. So, okay, so I'm going to start with a weekly chart of Bitcoin. So because for me, there's like two ways to, I'm going to clean this up while I chat to you. So there's like two ways to look at this correction on a weekly for me. If we're still in an uptrend, then we should just be, you know, normally each swing, you look for a reversal 38.2 or 50% back, and then it can continue higher. So when we look at this last swing higher that we've had in Bitcoin, you know, really that's all we've done. We've come back, you know, halfway, and potentially we could keep rallying from here. So I wouldn't be surprised if that's what we do in Bitcoin and we do keep rallying. But the way the fibs have worked, you know, and we haven't gone into this high territory yet, but the way the fibs have worked, I'm wondering if we're correcting the whole rally, which means the whole rally from the January 2015 low. And if we are correcting this whole rally, which is quite a long one, then we have stopped, you know, at the 38.2, which is quite a common retrace level here. Yeah. But what worries me is if we're correcting this one, then we haven't done enough in terms of time for a correction, because corrections should normally take 1/3 of the time it took us to rally. So, you can see in each one of these, you know, the correction was 1/3 of the time. So if we're just correcting this rally, we've done enough, we're going to keep going. But if we're correcting this whole rally, we've done enough in price for a correction, but we haven't done enough in time. So what we could be seeing then is a big triangle and sideways consolidation. And I think that that's going to confuse more Bitcoin traders than anything else. You know, some sideways
chop ring, because they're used to a trend. Yeah.
Exactly. So what's going to tell me that that's what we're doing? I think an ABC rally from the lows will say that we're still corrective. So this is what I'm measuring here. So if I measure from this low to this high, you can see that we're at the 61.8 of this first leg higher. So I've got two levels where if we're still in a correction, I'm expecting us to turn lower. This one here, 4229, which we've just tagged, and then a little bit higher at 4664 is an ABC correction. So I'm watching the price action here very closely today because we could turn higher from here or a little bit higher at 4664. And that, and then I think if we go to the higher one, then we'll probably see more of a triangle or a wedge, you know, and then we'll see another leg lower like this, and we'll go like this, and we'll build a kind of triangle. Correct.
Wouldn't that, Nick? Wouldn't that be a if it got up to that you know 46.64 level? Wouldn't that set up like a Gartley pattern? If
exactly.
Okay.
Well, yeah. So a bat actually, but yeah.
Okay.
Yeah.
You know, Nick, I was going to ask you. A lot of bears are thrown in the towel on energy, and you've had some nice pips trading the long side over the last quarter. And I think Rega had 52 as a target for a long. And
I just got my bear suit. I just got my bear suit out of the closet.
Oh, did you for crude? So
I'm just dusting it off. I haven't quite put it on yet. Maybe I'll have that for next week.
Are you a brown or a black bear?
Funny you say that, Nick. I'm gonna blog on crude today. So
that's why I brought it up. You know, I mean, you're gonna do. Yeah.
I'm just dusting it off and I'm getting it ready, but I haven't quite put it on yet.
That's
so
funny. I took mine out for Halloween, actually. A little premature.
Well, you might be able to wear it for a week or so in the S&Ps here, Blake. But so do you have a crude look? What is So you think the bears
really,
are thrown in the towel at exactly the wrong time is the drift I'm getting.
I think that a small time frame that we have another push higher. I think that Brent, has been massively outperforming. Brent has been massively outperforming WTI, and so then you go, I wonder why that is. And there's been a lot of stories about China buying, and that they're to fill up their strategic petroleum reserve, and that's apparently nearly full. So that would be if China stopped buying, then that would be, quite something. So I think that may be why we've been seeing the outperformance in Brent. And if it now reverses soon, that might be a signal. So yeah, I'm kind of, it's, it would be seasonal as well if we, I'd like to see Brent pull cleanly away from these previous highs at 58.35. I think, and if we don't, I think we're seeing an irregular correction here. We've made a marginal new high and we'll head lower. A reversal for me in Brent would be back below 55.90. So yeah, I'm not there yet, but I'm getting ready to put my bear suit on, yeah.
Okay, because WTI looks to me, as long as we're holding, I don't know, I think it was 50.50. That kind of looked like a breakout, either a cup and handle or something. And as long as we hold those levels,
I'm just going to put
level.
We're not quite here. So I was looking for, this is the continuous chart, so it looks a bit different. And I'm just going to clean this up and I can show you what I mean. So yeah, I think if we see, and again, this is like Bitcoin's extended sideways consolidation before the next big swing. And so I think if we see an ABC correction, if we don't go beyond sort of 53.80, 54, and then we head lower there, that potentially, we're still in a correction. And if we take that out and we take the prior highs out, then I'm completely wrong. But that's what I'm kind of looking for. 60 to 62,
it looks to me, which, I don't think many people are talking about it, but.
No, and I think that we've got actually a much bigger bottoming pattern if we do that as well. So, but yeah, but I think back to 62, yeah. And then, there was a lot of talk for a while about inverted head and shoulders, but we really, we have no symmetry at all. I don't think it's right to.
Yeah, it needed to dip. It needed to dip to like under 40 or something. That's what. Yeah, it never did it, and it's so stretched out. It couldn't just be massive consolidation of the first move off the lows from the crash low, and we're getting ready for another wave.
Absolutely. But for me, I think that everybody's a little in crude like positioning and sentiment is huge, and everybody's a little bit too bearish again, bullish again. And so if we did an ABC correction back to the 50% that we've never tagged really. We've tagged the 38.2. I think if we got back down here to 40, everybody would be super bearish, and that would be the rocket fuel that turns us around for the next leg higher. At the moment, it's just a bit too easy to buy it, I think.
That's it's a great point. I mean, inflation is what everybody has been, kind of hanging their hat on in recent weeks and recent months, and we've had central bankers come out just over the last couple of days and talking about how inflation is probably going to disappoint into the remainder of the year, which could weigh on this bullish sentiment in crude that we've seen in recent weeks, I think.
Yeah, definitely. I definitely agree. So I will say something about.
Go ahead.
I will say something about this. Like for me, all of these dollar pairs are really at quite interesting levels today. I'm going to start with the dollar Canadian that squeezed.
I was just going to ask you that.
Bunch of people. So the dollar Canadian squeezed a whole bunch of people out with this move higher. And not just you, trust me, not just you. I got squeezed out of the euro dollar by buying an ABC, so I got in a bit too early. But today we have tagged the 23.6 fib from the high on the 5th of May. So, which actually I've got it quite, or not quite.
What's so interesting about psychology, Nick, is when we were down at 121, people would have begged for an opportunity to get short at 25.
I know, and then when you get
And
there,
now we're
like,
here.
oh,
Now
God,
we're
I
here,
don't
and
want
they're
that.
afraid of it. Now they're afraid of it.
Exactly.
So it's classic.
So 124.70 is a 23.6 fib from the high and in May to the low that we just made at the beginning of September. And
Yeah.
for me, you know, that's my Fibonacci bull bear line. It's also 24.61 is also the low from way back in 2016 in April. So I think that this is going to be one of those big levels. I think that we've just crept above it to squeeze everybody out, because I think everybody sold the retest and put their stop above it, and we've taken out those stops. And
Yeah.
I would not be surprised at all if the dollar Canadian goes lower from here and sticks its thumb up at us, Blake, and the same with the euro dollar. And so, yeah, that's what I'm watching. If we continue higher from here, I'm completely wrong. And then my next level in dollar Canadian will be the 23.6 fib from the 2016 January high, which is at 26.82.
And if you're right,
1.2682, I mean.
if you're right, we're going to your long talked about target AB equals CD. That's
Yeah,
where your
115.65,
return
yeah.
line is too on the channel.
Exactly, yeah. Exactly. That's why I'm looking if we continue lower from here. So I don't know that we'll turn. And very often, you know, in big ABCs, I like to put the 23.6 from the high. So I really, you know, if we squeeze any higher, 126.82 is where we go. But I think where we are today is potentially a very good pivot point. And I see exactly the inverse in the euro dollar. So, you know, you can't ignore the price action. We've got a little double bottom here. This is a 4-hour euro dollar.
Yeah.
And so potentially we could do something like that here. But for me, the fib support that if we keep going a little bit lower is the 116.85 level. So, and these lows. So potentially we could bounce from here. That's the high, isn't it? From, if we go all the way back, that's the high from 2 years ago in euro dollar. But if we go a little bit lower, then, and this is just a spoofy wave 4, then 116.80. So this is what I'm watching in euro dollar. If we need one more leg lower, I'm looking at 116.80. So
this
that's
whole move from the high that we peaked up around a little over
I still say
21.
correction.
Yeah, and we could be on our way to new highs. So a lot of people are saying, Ellioticians, Greg, I know, like Hardianto, that this rally in the dollar is a 4. It still could be a 4.
Yes.
We could have one more washout to the downside.
Yes.
I completely agree.
Oh, look,
and
there's
I think
Hey, Greg.
I think that for Fibonacci reasons, and if I can find the chart, I'll explain to you why I think that. I'm just going to try and pull it up. Everything's going a bit slow on this. I don't know this.
So that would tie in with Canada peaking up here as well, and a pullback in the yen. And
hey guys, just FYI, we have final GDP and unemployment claims coming out in just 1 minute from right now. Just FYI, just in case you see a little bit of movement.
Flurry.
Go ahead, Nick. I just want you guys to know that we have data coming out.
Blake's got his hand on the trigger, guys.
I'm just watching carefully.
He's out on the street with his 6 guns.
Okay, so I'm weekly, but I think I need to zoom out more. So I'm going to go to a monthly dollar index chart here, and I'm going to look at this swing high from here to the lows that we had in 2008, and I'm going to put on 61.8, 38.2. Jobless claims. Everybody ready? I'll shout it out because I've got the squawk on.
Sounds good.
Okay, so we reversed on the weekly in the dollar index at a 61.8. And for me, I'm just cleaning all this up. For me, when you reverse at a 61.8, you go to the 38.2 next. That's why it's called the golden ratio zone. And that's where I'm looking for support. It's 89.92, and it's still above that wave 1 up here, which is a little bit lower, 89.50. In fact, if we come back down here, this is an epic buy because you've got a really tight stop loss. So I'm looking for
And that would shake out every long, Nick.
Yeah.
You know, everyone who says, okay, the dollar's good, we're going to 97 by December. So it'll, you know, mean Mr. Market will shake out the premature longs if this works out. And then they won't recommit because they've
Yeah.
taken a hit, and the move they're looking for will occur most likely without them. So I would love to see that play out.
So if that's true, and this is the golden ratios works, then there's the resistance, the pivot in the middle is 95.86. That's how it works. So if we do get a significant rally, we won't go above 95.86, and then we'll continue lower to 89.92. But I actually don't think we'll go that far. I think we're pretty close to. I could definitely see a leg lower here. So that's my view.
Maybe from today.
I don't know, let's put on the, where's that magic 23.6 fib? I don't think we're quite there yet. I think we could still go higher, and we're not quite there yet, 94.34.
Okay.
Wait, no, I haven't quite lined it up right. Here we go, 94.03. That would line up with that slightly higher target in dollar Canadian and that slightly lower target in euro dollar before we turn.
Okay, and that's Grega's bull bear line in the sand, right, Grega?
94.03. Cool.
I think 94.30.
I love it when I agree with Gregor.
Yeah.
For that
Okay.
swing high, I'm looking to view resistance from August. That swing high at 94.
Exactly, that's the same. Yeah, same thing. 94 exactly. August.
So maybe, like you said, another leg down on euro dollar could be seen, maybe towards 1.16 dollar index higher, and then we watch out for a turn. At the same time, we also have probably 5 waves down from this week actually, or from Friday, I think. On euro
Really
dollar.
good. Nick, you and Grega are fraternal technical.
I better get off and let Gregor have his screen or his screen.
But you're his twin technical sister.
I'm a huge fan. I think that I've been following Gregor as long as I've been on Twitter, so that's like, I don't know, 2008, 2010. So yeah, huge fan. Great to be working with him after all this time. So.
What a team played
You don't need to count waves, huh? I have to.
I don't count waves because Gregor does it for me. So, and Gregor, you know, does some great crypto stuff too. He's very good. So I always look at his crypto wave counts.
So hey, Grega, did you want to take the screen from Nick and show us some wave counting?
Yes, sure.
And Nick, hey, thanks for all your views too. Always great to hear what you have to say about the markets, and your views on crude are pretty much in line with mine too. And I'm going to be dusting off my bear suit here very shortly, I think.
Yeah, Nick, thank you. You're one of my favorite sounding boards for my lunatic ideas.
I love your idea about stock indexes, definitely.
All right, bud. Thank you so much, Nick. And I love, you know, people, it's infectious. You could tell you're having fun doing this. You're laughing, and it's great to have you here giving compelling stuff and giggling about it. It's a great combo. She's giving compelling, actionable ideas and giggling at the same time. So
I'm going, oh, people will think my charts are so messy.
No way.
Great.
Okay. Thank you.
Thanks, Nick. So, Gregor, what's happening over there?
The Wizard of Waves, who I interviewed on FX3.
I missed the start of the webinar, so I'm not really sure. What's your view on crude oil, Blake?
Well, she was just saying she's dusting off her bear suit, you know, going into seasonality, and I'm looking at crude at the multi-year trend line coming in at $53, and I know we're just past the summer driving season too, so you know, and the market's really bullish crude, and the market's been, you know, extremely bullish with the you know, thought that inflation is coming down the pipe, and I think you know, it's been and she had mentioned it's been an easy trade for the long side, but you know, we're getting up to some pretty key resistance, and if it holds, we could, you know, probably shake out a little bit of the market here. So, and I'm kind of in the same boat as her as far as my line of thinking.
Okay, I think Nick has to put me screen, right?
I can do it.
Yeah.
I got it.
Okay.
There you go, bro.
There, now you got it.
Okay, so you see New Zealand dollar, right?
Yeah.
Yes.
Okay, perfect. So as like Nick said, we can be still in a corrective wave here. in a wave 4 and expecting another push down into wave 5, but I'm not really sure if we'll see this stop of wave 4 already this week, because I'm looking here at the 4-hour chart, a 3-wave rally, and it looks like that this either it's a wave 3 or wave C has to be made by 5 subwaves before we may continue to look to the downside. So for the near term, let's say till the end of the week, we could easily stay on the bullish side of the dollar index. But I'm waiting for prices to potentially drop either from here or from higher levels to drop and confirm that we are headed even lower if we get beneath 92.54. In such case, I would most likely look for opportunities on cable, because on cable, I think that we are in a corrective pullback on the 4-hour chart. Notice that we have seen quite a nice retracement this week, exactly for 38.2% compared to previous wave 3. And if you take a look closely at this price structure within this decline, here, especially here on the hourly chart on the right, you can see that there are plenty of overlapping moves within this wave C, third leg of decline. And normally, if you see wave C much slower and overlapping compared to very sharp wave A, then normally that's an indication that we are probably in final stages of this corrective setback. So I can already see some nice bullish reaction. Right now, I'm not really sure what was the cost for this move to the upside, but so far it looks promising, and I'll not be surprised if we see cable ticking much higher, especially if we get dollar index breaking beneath that 92.54. So if we'll see, let's say, a bullish daily close above this channel resistance line, then probably I would look for opportunities on pullbacks against this current low.
Yeah, it's great. It's great that you say that, Grega. That 38% retracement on the 4-hour chart. On basic technical analysis on ForexAnalytix, we were looking for a move to 133.30, and we stopped shy at 133.42 today. Yeah, so
yes.
it went right where it should have gone.
Yes, and if I take a look on a 5-minute chart, I do not look at these structures, Elliott wave counts on such a slow, low time frame, because I want to avoid intraday noise, but still you have a pretty clean 5-wave advance from the low. And normally that's a strong evidence that here a low was put in place either for only ABC recovery or maybe for a new impulse of a higher degree. But in either case, I think that this low could stay in place for the next at least 24 hours, if not more. But ideally, we will see prices sticking much higher, as I said, here above this channel resistance line. I'll go back to 1 hour. And then, as I said, I will most likely look for potential long opportunities. So this cable is on my radar screen. What I really like is also not crude oil, I'll cover it later, gold. I haven't covered much gold lately in webinars, especially because I was not so convinced into this bullish rise that we have seen. I don't remember when I traded it last time, but now we have a pretty clear structure which suggests that the gold has put a top in place, at least temporary, and that we are headed much lower. But in the short term, we should see a 3-wave rally. And notice that this 3-wave rally should then unfold against these 5 waves of decline. And we know, as I said, on cable, on 5-minute chart, here on 4-hour chart is the same on gold, but on the opposite direction to the downside. If you see a 5-wave movement, this should be very strong case that confirm a significant change in trend. And it looks like gold could stay under pressure here. And what I see is actually that market will stay, metals will stay in this big range that is already unfolding since 2014, I guess. So I would not be surprised if we see even much lower levels by the end of the year here for gold. As I said, we have 5 waves down. Watch out for a 3-wave rally and expect more weakness. Silver is in a very similar position. So all in all, it would be very interesting to see dollar index maybe moving even lower once we get a free wave bounce here on gold. Okay, makes this sense? Anyone listens?
Yes.
No, one of the other things about gold too is I think that gold when it broke above 1300, it really got a lot of shorts out of the market and got a lot of people long. So now you probably got some pretty, you know, to hear that you think gold could, you know, stay under pressure for the remainder of the year. It's really interesting. I think it's probably not what the rest of the market is positioned for at the moment.
Yes, but if we take a look at 10-year US notes, I don't know what is your view there, but we have seen a pretty aggressive move to the downside there. So it looks like there is more weakness ahead, and this should put some bearish pressure on gold as well, I guess.
Yeah, makes sense.
Yes, so that's for gold. Also, I don't know if some traders maybe caught this crude oil PIP that I shared earlier today. What I was looking at is for more upside within current recovery. On crude oil, we have nice higher highs and higher swing lows here. So clearly, we are in some midterm uptrend here. And I was looking for another triangle to be broken today. And looks like that we can be headed now towards our target at 53. This recent swing low here, if I go to smaller time frame chart, swing low just established here at 52.40 will hold. It was the previous high, as you can see here. Okay.
Nice. Yeah.
So as long as this level hold, I think that there is maybe a final push higher coming in play towards 53, but then watch out for a reversal, because triangles, as you know, occurs prior to the final leg within the larger uptrend. So this, if we take a look at the price action for 50.25, it's a 5-wave movement, which means we are now in a 5th wave. So a 3-wave corrections will likely send us back into this triangle range, maybe already tomorrow. So watch out for this. But as long as we are above 52.40, I think there is bullish pressure still in play for today's price action.
Cool, Greg. Listen, Greg, you know, Canada's gotten back to where bears are also starting to convert because they've tried to sell this rally and it's been relentless. I'd love to see your view on USD CAD.
Sure. I think that we are still just in a corrective rally. If you recall, we were tracking this channel resistance a month back or so, and you can see that market always reverse lower from this lower trend line. Okay, so here we were looking for wave for pullback back towards this trend line resistance. We have seen a nice sell-off, even a retest of this trend line caused another sell-off. And now we are again back at these trend lines. Okay, so what I see is potential new corrective wave 4, and we could easily continue to the downside. I'm not really sure if already from here, because normally there is a 38.2% retracement for wave 4 compared to wave 3. So we could see slightly higher levels, maybe early next week. But what I would pay attention for.
Where's it come in, buddy? 26.5 about? The 38.2?
1.26. That would be probably my upper resistance.
Okay.
That should be acting for a reversal. But what really matters is at this stage, not from where market will actually turn to the downside, but when it will turn. Okay, and when the top will be confirmed is will only be confirmed by the price action. So if we'll see maybe even from here 5-wave drop, and let's say we go back below this latest swing low here at 1.233, then I would probably looking already for some shorts on the pullbacks.
Got it.
Clearly, and
so let the market prove itself and then look for the next reaction to enter.
Exactly. It can be from here, it can be from slightly higher levels, but as I wait on a confirming price action, just patience, nothing else. So
great mentoring too. Thank you.
You're welcome. Any questions, Blake?
Sorry, I was on mute. No, it's interesting that the dollar Canadian, and I was stuck on the wrong side of it yesterday. I had a decent short going into the Polis's speech, but he really wrong-sided myself and probably a lot of people, and I think the positioning is really skewed towards towards a continued squeeze. So I think a move to 126 would not be surprising to me whatsoever at all, actually.
Actually, I was on the wrong side too as well. I shared PIP as well on CAD yen.
Yeah.
But I went in, as you know, a little bit earlier, 24 hours earlier. I think it was around 90.70 or so. We have seen a nice move to the upside, and I was on a trigger to at least to close some shorts here around the highs ahead of the event, but I don't know why I didn't. I should, like Paul Tudor Jones said, that always took at least half of position around the important highs or lows if you are short or if you are long. So
yeah,
these are very important levels where market can normally either reverse in the opposite direction after a spike or after it moves very close to that levels. So, and yesterday this proved to be right.
Yeah, it was one of those situations that I knew it was a make or break type of price at the 124, 124.50 level. So, hey, Greg, we always appreciate your views, and I know our Forex subscribers that use the Elliott Wave tier on their subscription really appreciate your views on a daily basis. So thank you very much. Hey, if you don't mind, I'll take over the screen unless you have anything else you want to cover. I just wanted to cover a couple things before Jim gets here.
No, actually, that's it.
Okay, sounds good. I'll go ahead.
Greg.
Thank you.
Greg, you're awesome. Thank you so much.
The Wizard of Waves, I call him. So now, Blake, I put out a tweet. I said, when I interviewed Greg on FX Street, I said, man, that guy sounds confident. You could tell that someone just has conviction about their work.
Yes.
And since I've been at ForexAnalytix, now I know why. So go ahead, bro.
No, he's awesome, and he doesn't waver on his views, and it's and that's it's like traders, like I hate using the gambling analogy, but like when I'm not much of a gambler, because I know I mean gambler, I'm talking like Las Vegas or whatever, especially when I play table games, because it just, I know that the everything's skewed against me, so I just do it more for entertainment value. But I do it everything by the book, so it's like, okay, if I'm going to play this game, and the ones what's going to give me the highest probability of walking away here without losing my ass is going to be just following the rules. So I follow the rules. But when you're trading, you can actually skew the risks, prevent them and put all the benefit in on your side if you follow the rules. And that's why he looks at the risk reward as far as technical analysis is just, I'm going to do it by the book, and this is what it says, and if things are going to go wrong, of course. And that's how you just have good risk management. And you have good risk management, you can manage your trades, and that's what we do. And he does everything with conviction, and I love it. Now I want to talk really quick, because you guys are in for a really big treat. You guys got Jim Welch today. He's a great macro mind. I love reading his newsletters. He's awesome. So you guys are in for a really good longer term macro view of the markets, and probably some pretty good technical viewpoints as well.
I don't see it.
But are you talking to me?
Oh, I'm sorry. I'm talking to Jim right now.
Oh, okay. But I wanted to cover just a couple of things really fast. So Greg was just talking about the pound dollar, and we were all, as well, just looking at the 38% retracement of the pound. We've been talking about this before it happened, about coming down to 133.30 and then bouncing, and it came, you know, within about 10 pips of that 38% retracement breakout point. And it is bouncing. Now, what's really going to be key over the next couple of days is the move above 136 or 136.50 if we can get up there. I don't know if we're going to get up there. Obviously, this is a multi-year trend line. You can see multi-year trend line coming into play. We have a lot of work to do to get above it, but also I've read from a couple different sources that cable demand going into the end of the quarter might be relatively high, so you gotta keep that in mind as we go into the end of the quarter as well. Steve just got back. He's going to take over here in just a minute, but I want to talk also about the Canadian. I got stuck on the wrong side of this yesterday as it was trading below 124, but as you can see, we popped through that. This is a multi-year trend line, guys, so just so you guys all can see it. And the reason why I was shorting it is because we were below this dotted or dashed line yesterday. And, you know, my thoughts were, as long as we stay below that, I'm going to stay on the short side. And we had this this channel that had been in play. But obviously, after Polis's speech, we spiked up, and I closed out just above 124, my shorts. I took a little bit of a loss because, you know, I was short at like 123.80, so I took a bit of a loss, and it's rallied to channel resistance and also the 618 retracement. So if you guys are trading the Canadian, just note why the highs are what they are and why they've held. They held because you have this channel resistance. You can see it right here. Okay, you can connect the spike low over here, spike high, and the channel resistance comes right into play right at the 618. Now, for obvious reasons, if we take out these highs, the US dollar Canadian could continue to squeeze. I have to mention that the market is extremely long Canadian dollars. Now, I know I was trading in the direction of, you know, the positioning, which I think was skewed anyway, but because the market is extremely long Canadian dollars is a reason why we could continue to move higher. Grega thinks, you know, 126. You know, I still think it's possible that we go even higher than that if you know, you sprinkle in a little bit of risk aversion. You get commodity currencies coming under pressure. The dollar Canadian could go a little higher. You take the US dollar Mexican peso. This has been showing us a big sign of reversal for the last week and a half. I know myself and I know a lot of other traders have been long the US dollar Mexican peso. I've got bids to buy this thing on a dip down to 107, 106. They haven't even been close to getting triggered because I'm trying to buy it on a dip now, and I know everybody's getting squeezed out of this because, like the Canadian, the Mexican positioning is lopsided as well. There's a lot of people that are long Canadian dollars. There's a lot of people that are long Mexican pesos. But if you read, if you go to our blog and the blog that Steve Volgi, Stelios Contagoulas and myself wrote about the dollar and about the potential reversal for the dollar, there's things that we are looking for that have all really come to fruition, and the US dollar Mexican peso was one of those that has had it's been very resilient in the face of dollar weakness, and so now it has really turned the corner, and I think the US dollar Mexican peso can really go higher, especially if there is any type of risk aversion in the market, which at these elevated levels, I'm sure Jim's going to talk about that. You know, if the market comes off at all, especially this time of year, we're in a seasonally very tough time of the year before the Christmas and Thanksgiving holidays, when the stock market usually finds its footing. You know, September, October, usually, you know, tough months for the market. So, you know, if the stock market comes under pressure, we could see the US dollar Mexican peso go higher. And that's why I still want to target this currency pair, maybe the US dollar Canadian for higher levels moving forward. But those are things that I'm looking at going into the next few weeks. So with that being said, Steve, you just popped back in. Welcome back.
Thank you, Blake.
Hey, I wanted to give you just a couple minutes just to say whatever you got to say before Jim comes on. Jim's coming here in 5 minutes, so I'm gonna flip it over to you. And
okay, thank you. Although I wasn't here, so I understand that both Greg and you spoke about things. Is there any of the popular pairs that you haven't seen, so we can so at
you
least
know, Nick was here, Greg is here, and myself.
Perfect.
You know what we haven't really discussed a lot is we haven't discussed the euro or like the Kiwi. So those might be a couple that
Sure. Did you talk about oil?
We did.
Okay.
All right. Thanks, Steve.
Okay.
Welcome back, and just be mindful that Jim's going to be here in just a couple minutes.
Sure. Dale is gonna tell me when, and I'm gonna cut it there. Okay.
Great.
Actually, Steve, I need some help with Jim. He did a call in and he can't figure out the audio pin. Can you give me some direction?
Sure, but Blake, are you still here, mate?
I am.
Okay, then then you
Why don't
go
I
on.
take over? Okay. Why don't I take over so you can help out? So, all right. So here, you know what? Since we were
Blake,
just talking.
Kevin Hercom said he lost sound. Kevin, are you everyone else could hear Blake and everyone, right? Give me a Y.
Yeah, I don't.
It's just one person loses a sound.
It is, and sometimes
Back on. Okay.
yeah, sometimes Citrix has a bit of an issue. Okay, I'll let Steve handle that. So really quick with the euro. The euro, by the way, I think is in no man's land at this moment. We've got this. We have this breakdown of this the strong uptrend. Steve's been looking at a little bit of a head and shoulder pattern. You can call it a head and shoulder pattern, range extension, whatever you want to call it. But we're getting down to prices where people are going to start looking at the euro as an attractive long, or the dollar as a possible short. So you gotta start looking at these prices and get a little you have to be a little careful as we are getting down towards this the 116, 117 level. I think that as we get down here towards the 161% extension, this little channel low, this is going to be where we find a lot of support. Now the euro thus far, and one thing that I have to note here is that we made a higher low. So because we made a higher low, it kind of skews my view a little bit that we're going to get down down towards the 116.50 level. We've kind of stopped premature, if you will, and now, like I said, it's kind of in no man's land. We're between the 127% extension and the 161% extension. I don't have any real technical reason to be a buyer, but if the euro does get a bounce, you might get a near-term bounce to like 118 and change before heading lower again. The dollar is not going to be, I don't think the dollar is going to be an easy trade. I don't think it's going to be an easy long. We have, if you look at the dollar index, we've come out of this, this down channel, but the dollar, remember, has been in a very bearish trend for, ever since inauguration night. So because of that, I'm not 100% convinced on the idea that the dollar index is ready to turn longer term, and I still, other than knowing that bonds are dropping and yields are rallying, it's not a clear-cut indication that this is the catalyst that's going to continue to drive the dollar higher. I'm just not. I haven't gotten there yet, and we discussed this over the last couple of weeks, kind of thinking what can turn the dollar higher, and if it does, well, what's the fundamental backdrop behind buying the dollar, other than maybe the positioning is wrong, and technically we're seeing a bit of a reversal. So those are all things that I think about when I'm like, okay, well, do I really want to be a dollar long at this point in time, or am I better off, or are we better off looking for shorts you know, as it rallies into some resistance. So that's kind of what I'm thinking at this point in time. I know Dale's still working with Jim trying to get his audio on. So let's also take a look at the Aussie and the Kiwi. There's the Kiwi. Kiwi's taken out a little bit of an uptrend line, but we're still holding support. And the 200 day is just below.
Yeah, that was the number calling.
And the 200 the 200 day moving average comes in at 71.50, which, you know, this is going to be really critical, because I think if we break this, you know, this level here, that's when you know the Kiwi could really come under some pressure. But if you look at the Kiwi's broken a little bit of an uptrend line, so it's going to make it more difficult for the Kiwi to bounce. Aussie as well. The Aussies, you know, tested some support here. Matter of fact, I'm going to go ahead and take this. I'm going to take this support here, and you can see how we probe those lows, and this is probably very key. If I was short the Aussie right now, I would be moving my stops to break even, or whoa, sounds like we got some sound here.
Yeah. Yeah.
Is that Jim?
That's me. Hello.
Hey,
good morning.
Hey, Jim. Good morning. It looks like we've got you. And now the question is, where's Dale?
Where is Dale? Dale or Dale, where art thou? Okay.
I'm really looking forward to this.
I muted Dale before he needs to unmute himself.
Here I am, guys. Thank you.
There he is.
Thank you very much for your help, and thank you, Jim, for trying, and Blake, thanks for filling in and giving some great ideas. So, Jim, I'm going to make you the presenter now.
Okay.
And we could hear you, and now you'll be able to share your screen.
All right, give me one
option pop up.
Let's see here.
Anyone who's interested in what the Fed decision last week and what Draghi's up to needs to stick around for this. So you see that there's your screen.
Okay, let me pull up the PowerPoint, hopefully, and then we should be good to go.
Okay, so Jim writes a great letter. I've been reading it for decades. In fact, Jim, what was the name of your first letter? It kind of had to do with your main thesis was following Fed action for having an idea about what markets would do. So I forgot the name of it.
The first one was called The Financial Commentator. I started writing that in the mid-'80s.
Right.
And it initially started as a technical piece, but as we got into the 90s, I started more and more focusing on the Fed, and I actually used to read Greenspan's speeches, and I always found them actually kind of informative. He was very precise in how he talked, even though every sentence was as long as a paragraph. So one of his famous lines, I think, was, you know, if you understood what I said, then I made a mistake, or something like that. So, but anyway, I think we're really at a very interesting juncture, both in terms of the Federal Reserve and the ECB. As everybody knows, the Fed made an announcement last week to begin to trim their balance sheet. It's going to be a pretty modest process over time. The interesting thing is the bond market took it somewhat in stride. Bonds had sold off for 9 consecutive days before bouncing on Friday and Monday, and of course yesterday they got hammered pretty good. But I think the key point here is in terms of the Fed, that the probabilities of them raising rates in December, I think, are really, really high. Today's GDP number supports that. But the other thing the Fed is almost crazily obsessed with is the level of inflation. And the target is 2%. And that was initiated in 2012. So prior to 2012, the Fed's mandate was just stable prices. So if you think about a 2% inflation rate, money doubles, if you will, every 36 years at 2%. 2 into 72 is 36. The average person now lives to be about 80 years old. So in terms of the Fed's idea, prices are going to quadruple during a normal person's lifespan, and yet the Fed will consider that a success. So to me, the 2% target is kind of, I don't know that it's the right target. But the reason why the Fed did it in 2012 was back then, everyone was worried about deflation. They wanted to kind of shift, people's attention that we're going to keep monetary policy until we get that, so you don't have to worry about deflation. Here we are, 5 years later, and the Fed is still harping about 2% inflation. Inflation, in terms of the core inflation, was about 1.6 to 1.7 in the last couple months, and yet they feel this need. And there's some objectives that they have in terms of getting the Fed funds up to about 2 3/4. But the other risk is that as they keep policy maybe more accommodative than it should be, asset prices and the issue of financial stability becomes a problem. Because if you look at the leveraged loan market, I'm sure everyone's read about stock values, bond yields being down. I saw a chart the other day going back to 1800 and looking at bonds and stocks in 15 different developed countries. Prices are more expensive now than any time since 1800. So certainly central banks have been successful in boosting asset prices, but in terms of wages, that hasn't gone as well. Economic growth has not really gone all that well unless you consider 2.2%, success.
Okay. So let me ask you this, Jim. If the Fed has been aggressive all these years and they're still not able to generate that, just arbitrary target of 2% because we had deflation fears, is deflation still the overriding force that intervention couldn't correct? Or have they stayed loose too long that they're going to have a problem and wish they had a deflationary problem?
Yeah, I mean, that's a great question. I think at this point in time, given their inability, and not just the Fed, every central bank on the planet, inability to get inflation up to 2% suggests that deflation is still the problem. And there's a couple of reasons. The primary one is that there's more debt now globally than there was in 2007. So, the last 8 years, what's happened is around the world, more debt has been created. And yet back in 2007, global GDP was running at about 5.5%. This year, the best estimate is about 3.5%. So the point being is back in 2007, when there was less debt, global growth was actually 50% faster than what it is today. And yet everybody keeps talking about a synchronized global recovery. So the risk, I believe, is that you have more debt, slower GDP growth, so that the next slowdown really becomes problematic because interest rates are already very low. As everybody may remember, back in 2007, the Fed funds rate was 5.25. Right now, it's at about 1.15%. Fed says they want to get it up to 2 3/4. So the leverage that the Fed has in terms of counteracting any kind of economic slowdown is far less today than it was in 2007. So
that's a pearl. So you think we could move on to another slide and start looking at
one of the charts? One of the things real quickly I try to do is combine fundamental analysis with technical analysis. To me, the combination of both provides the kind of synergy, and it provides me the conviction when I see things developing fundamentally and the technicals confirm it. Then I think the probabilities of it, the forecast, if you will, is much higher of turning out. The things that I look at are sentiment indicators, looking for extremes in sentiment. That also ties in with positioning. So when you look in the futures market, particularly in things like gold, bonds, oil, because there's huge positioning issues that go on in those markets particularly. So when you have a lot of positive sentiment and you look at the positioning, you see large speculators, extremely long, the probability of there being a pendulum swing the other way becomes, I think pretty high. And
a recent example, Jim, a recent example was I gleaned from your writings about the heaviness and huge, almost record long positions in euro before the high. So that was an example.
Yes, that was an example. The other examples, on the opposite side is huge shorts in the dollar index. Treasury bonds have had enormous swings. We're going to look at them in a little bit here. So anyway, the idea of looking at sentiment, positioning, technical confirmation, things that I know you folks talk about a great deal, chart analysis. Those are all the pieces that I think one needs to be able to kind of combine. And that's for intermediate terms, the tops and bottoms. And I think on balance, you guys are more focused on short-term moves. I really believe that having in your arsenal the ability to identify intermediate tops and bottoms is essential, because if one is able to do that, then you can have a core position and then trade around that core position. And all right, and so the benefit there is that instead of trying to take a few bips out of the market, now you're talking about 3, 4, 5% moves, which means in terms of total return, an enormous difference. So I really believe it's important to focus on intermediate terms, and those are the tools that I've used. Major tops and bottoms, you really got to tie in fundamental shifts. In other words, something's coming along to impair the U.S. economy, that it's going to start to really slow, go into recession, or vice versa. So I think the primary focus is intermediate tops and bottoms. We'll look at the bonds initially. Last year, the low in the 30-year was 210. In March, it got up to 320. That's 110 basis points. And a 50% retracement would be 55 bips. 55 from 320 is 265. And on September 7th, look at where it got to. Also, in March, you can see RSI. These are daily charts. You can see a huge non-confirmation in terms of as the 30-year was up at 320. Momentum was certainly not supporting that. And conversely, when bond yields dropped on September 7th to the 265, big divergence. So here was a case of looking at an intermediate term outlook, coming up with a 50% retracement, and noticing that the RSI wasn't confirming it. And so from an intermediate standpoint, this provides the opportunity for a position trade. And the reason is, as you can see from the bottom, the rally up to 320, I've labeled that A, the decline down to the 265B. What this portends potentially is that we're going to see a 110 basis point move to the upside in 30-year bond yields over the next 6-12 months, or however long it's going to take.
Yeah, I remember your writing, Jim. You were talking about you're buying the 10-year you thought was going to bottom around 210 or so, and it had one more jiggle to 2%, yep. Way above 210 now. 204?
Yep. Okay. Yeah, it was 204, and that was, again, just based on how things were trading. So going back to, the concept of positioning, here's what you can look at. This is the 10-year note, because the size of the positions are much, much larger. So if you look at this window time here, January, February, and March, and we can see that the commercials were long over 500,000 contracts. Large specs were short almost 500,000 contracts. Yeah. So this is the longest position commercials had taken, I think maybe ever, quite honestly. So looking at this information made me believe that we were getting set up for a pretty good rally in the bonds, decline in bond yields. The other fundamental aspect that I write about in the monthly stuff is I really thought that we were going to see the economy slow in the first quarter, going into the second quarter. We don't need to go through those details, but the point being is that if I was correct and bond yields started to come down, the huge short position on the green line, the large specs, those guys were going to start to lose money. And that as that started to evolve, they would, get liquidated. And as they were getting liquidated, they were going to have to buy the contracts back. That would cause bond yields, obviously, to come down. So I went long, recommended going long in March, got out in April, and then on June 26th, because my initial target was just about at that high. As it turned out, the next day, Mario Draghi gave a speech, and he started talking about the Eurozone's economy doing better. Right at here was the 50% retracement. What I find interesting is there wasn't really any economic news right after September 7th to cause bond yields to tick up 9 consecutive days. And so to me, that was terrific because it showed liquidation without there really being, if you will, a reason for it. Ironically, bond yields made an initial little high on the Fed day when the Fed confirmed that, yep, we're going to taper. We're probably going to raise rates in December. So to me, this is, I believe that the 10-year or the 30-year is the potential to run up. And I'm going to go back to this real quick. You know, looking at this there.
And I'll confess that, you know, when we were talking about like Blake, and, you know, I send Blake your stuff. He's my boss. And he was talking about, you know, what fundamentally could drive up the dollar. And he said he couldn't think of anything. And I said, well, how about yields? You know, bonds yields up, and you know, that I gleaned from your writings. So
right,
you know, well, everyone knows I'm an intelligence gatherer, and not all my ideas are original thoughts. So
right. Well, hey, never being ashamed to borrow somebody else's good idea. I mean, the idea here is to learn as much as we can, and wherever that information comes from, it doesn't really matter. There's most of what I know has been learned from my own mistakes, but more importantly from other people and what I read and be able to kind of put together. Here's a couple of things I'll make that I think are important. You know, now people are going to be talking about the Fed raising rates and squeezing their balance sheet. But let's look back in reality. In last December, the Fed raised rates. The dollar peaked in the first few days of January. What was going on in January? The sentiment towards the dollar was about 85% bulls. The positioning was extremely long, and there was a big short position in the euro.
You're still on the notes, so.
Yep. So the point being is that then Trump, and this is something I wrote about before he did it, on January 9th said, you know, the idea of a strong dollar, you know, makes sense on the surface. It's not so good in reality. And so despite the Fed raising rates in December, raising them again in March and June, the dollar declined. So now people are talking about the euro. Well, what could cause the euro to go up? And we're looking for strength in the dollar to kind of justify that. And I think it's somewhat potentially the opposite. The euro ran up 12% from the beginning of this year to the high just over 120. A lot of Europe is dependent on exports. So they're trying to get their economy to grow faster. They want inflation to go up. As the euro rallies, it makes their goods more expensive for exports, which is going to hurt their economy. And import prices are going to decline, which will weigh on their inflation rate.
Yeah.
So back in 2014, I wrote about in March that I thought Mario was going to talk the euro down. It had done a 50% retracement at 140 after going from 160 to under 120. And sure enough, Mario's, you know, that message got conveyed. The euro went from 140 down to 106. So I think we're going to see something similar in the coming months in the sense that they don't want the euro any higher. On July 9th, the last time they had a meeting, they said they were worried about it overshooting. The euro was trading under 115 at the time of that meeting. So, you know, so to me, part of the driver here, I think, is the positioning in the euro. You know, there's too many longs. It's a crowded trade. People hate the dollar. They're short the dollar. So this combination of positioning and, you know, I think Mario talking about how strong euro, you know, works against their purposes. So one point I want to make in terms of bond yields, because I think it's really important. As the central banks were intervening in buying bonds, if I'm a hedge fund, institutional bond manager, I'm going to buy bonds ahead of the Fed, ahead of the ECB, which would happen especially when the ECB launched their program, because I know they've got my back. They're going to suppress or repress rates. We're in a whole different world. They're entering it because now we're at a point where as the ECB curtails their purchases from 60 billion to 40 billion to 20 billion over the next 6 months or so, you know, if I'm an international bond manager or hedge fund, I'm looking around to say, hey, wait a second, yields are going to start to uptick. And at some point in time, it's going to be every bond trader for themselves. And I believe there's a light that's going to go on where people say, you know what, I'm not going to wait to see if the ECB is able to pull this off without a disruption. I'm going to lighten up ahead of the game. And I think that is coming. And that's one of the reasons why I think bond yields are going to go up, not just in Europe, but in the U.S., because yields are globally tied. And as our yields have ticked up, yields in Germany ticked up over the last week. And if I'm right about the ECB moving forward, announcing their QE program being wound down at their October meeting, I think there's a point in time where German bond yields are going to make a run up to 90 basis points, maybe 1%. And if that happens, that's one of the reasons why I think the 30-year and the 10-year can get back up near the March highs. So, you know, again,
can you explain how that would lead to a lower euro with them tapering in the ECB tapering? Why that would lead? I don't get it.
It's counterintuitive. But if I had told you, hey, guess what? The Fed's just raised rates last December. They're going to raise again in March and June. Everyone would say, well, gee whiz, that's why I'm long the dollar. Okay.
Right.
Well, the positioning was too big. So you just get the positioning is a huge thing. The sentiment is a huge thing because you get crowded trades, and crowded trades eventually get unwound. And that's where the technicals can be helpful in terms of identifying when that's likely to happen.
And how about higher rates weaken the economy as well and make leverage more difficult with derivatives?
Well, definitely. Yep. You know, all that stuff will take time to play out. Because rates are still historically quite low, you know, even with the 10-year where it's at today, even if it gets to 260, even if it gets to 3%, that's when things will really start to bite if it gets up there. But that stuff kind of takes a while to play out. But I think the bond market was surprised in the U.S. that the Fed has a degree of resolve to raise rates. And again, I think one of their biggest concerns is they want the Fed funds rate up to, at least as they've stated last week, 2.75%. So they have some leverage to use a lowering of the Fed funds rate the next time the economy is slowing or going into a recession. So that's one of the prime motivators of why they want to keep moving by raising rates. Now, you know, things get out of hand, they'll change their game. Okay. All right. The dollar, the low last May of 2016, I believe was 91.88. So the dollar recently just undercut that a little bit. As we can see, the RSI made a higher low. In addition, again, looking at sentiment, I think there was 2 or 3 week period where the percentage of bulls on the dollar were under 10%. The euro was like 85%. You mentioned, Dale, the positioning in the euro, the highest long position in years, I think going back to 2011. So to me, this was one of those times where I actually recommended legging into this trade. As each time the dollar made a low over the last month, it was like, okay, when it makes a new low, buy a third, makes a new low, buy a third. And so the net is that we're long on the cash at 92.44 average price. I think the dollar fell from 103.80 and change down to 91. So that's 12.80. A 50% retracement is 640. Added to 91 gets you 97.40. And look at this high back here in let's see, it's about late June, right above 97.50, which may be wave 4 of lesser degree. So that's a target. A 382 retracement would be about 5.25 points. It gets you 96 and change. It gets you in through here. So again, from an intermediate term standpoint, to me, having a core position at this point in time, the dollar makes sense. Obviously, when it gets to here, we're going to run into some resistance. But the thing I will point out, for the first time going since January, we now have higher lows and higher highs. That's the first time that's happened. So that's another indication that this isn't just a quick trip trading. This is something that will last weeks to months in terms of working its way higher. And, all of a sudden, then out of the blue, we get they're going to try to do the tax cut. Whether or not they do it or not, it's the perception that will lead to a stronger economy. But that also means that the Fed is going to be forced to move. One other point regarding the dollar, the big decline in the dollar is causing import prices to rise because a cheaper dollar, it costs more to buy the stuff that we're taking in. So up until this year, the strong dollar was subtracting from the core rate of inflation because import prices were below zero. And over the next 6 months, the decline in the dollar is likely to add 0.2 to maybe as much as 0.3% to the inflation rate. So the point being is, hey, if that proves correct, all else being equal, the inflation rate, the core rate, is going to move from 1.68% to 1.8%, maybe towards 1.9% over the next few months. Again, what does that mean? That means the Fed is definitely going to be raising rates in December. And it also raises the probability that they will raise rates at least 3 times next year. Again, whether or not they actually do it doesn't matter. But as long as people start to think that, gee, that really might happen. That narrative is going to play out. People respond to it today, and I think that's one of the key points. In terms
I have a question from one of my partners, Steve Volge. He said, you said recession. Okay, you said the next time the economy goes into recession.
Yeah.
He's asking, when do you see that happening? How long does this business cycle last before that happens?
Okay, business cycles aren't determined. But yeah. It's a great question. Time doesn't matter. I mean, people say, well, this is the second longest business expansion, blah, blah, blah. It's getting old. That's cocktail party crap, quite honestly. What really matters is just looking at, where we're at right now, 2 to 2.5%. If they do get some tax cuts passed, that's going to add some legs to the economy in terms of growth. Then it comes down to how fast are rates going to rise. And that will have the biggest determinant in terms of when we have a slowdown. If we see anything like a yield curve inversion, that would be a big hint that, okay, 3 to 6 months later, the economy is going to really start to show signs of slowing. So to answer the question, I don't see it, over the next 6-9 months. The other thing is things like the advanced decline line in terms of the American Stock Exchange, is making new highs. Historically, the AD line peaks out and then begins to register divergences with new highs in prices, usually 3 to 6 months before a bear market begins. So again, based on where the technicals are on the U.S. stock market, I would say that, mid next year would be maybe the earliest. And obviously that's going to be determined quite a bit by, what happens with interest rates and Fed policy. Okay, dollar. We talked about it in terms of the positioning. I think, it's an intermediate trade. It'll obviously have pullbacks and so forth, but my guess is, move toward 96 to 97.5 is very likely. Looking at gold, last summer when gold was trading up, 1380 or so, the positioning in the futures, the commercials had a huge, I think like a record short position. Speculators were long a big amount. So again, from a positioning standpoint, it was way overdone. In terms of the pattern, big picture, gold dropped from 1920 down to 1040, $880. I believe a 50% retracement is going to happen, which gets it back up to 1480-ish. So longer term, I think that's where gold is going to make a move, 1450 to 1480. We had the large pullback from 1380 down to 1120. I think this was from here to here A, then an A, B, C. This is C. We're going to have a big pullback. This has been my expectation. Again, when this broke out, gold broke out above 1305. The commercials shorted it aggressively. And so you can see, here's their shorting as it broke out. So the large speculators jumped on it like crazy. And when we look back at, here's the low in late 2015, the commercials were actually net long here. They were, much less short at this low, and again here. But again, the positioning suggests sentiment on the gold was, I think, 85% bulls. So this to me said, I think this is going to be a false breakout. We're going to break below this. And, obviously that's what's happened in the last, during this week. I think gold can get down towards 1250-ish, possibly down to 1200. We just have to wait and see how it unfolds. And I'll be looking at positioning and, things like how oversold it gets. The other thing I'll mention is, let me go down one more slide here.
Before you, I just have another question, and it's back to central banks.
Yeah.
Do you see the BOJ following the Fed and BCE anytime soon?
No.
And so then your UJ, your yen view would be for what? a weaker yen?
If the dollar is going to rally, my guess is, and I haven't paid as much attention to the yen as the euro. The euro is 67% of the dollar index. The yen, I think, is 13%. So that's why I focus more on the dollar-euro aspect. But if I'm right about the dollar having this kind of rally, at least over the next 1 to 3 months, the probabilities would, I think, is that we're going to see the yen pull back. They don't like a strong yen, quite honestly, for a number of reasons. So, but I don't think the BOJ is going to change their stripes anytime soon. They can get away with it because all their debt, they have a huge mountain of debt. I think their debt is like $5.30 of debt for every $1 of GDP. That's the biggest lopsided ratio in the world. But most of their debt is owned by Japanese. I think the BOJ owns like 35%, and it's owned by Japanese. You know, so they aren't dependent on the kindness of strangers for their debt to the extent that we are. Okay, then last I was going to show you, this is a chart of the gold stock ETF GDX. And this is a very simple thing. It's a ratio compared to gold. And historically, the best rallies, both in gold and the gold stocks, happen is when the gold stocks outperform. So this is going back to 2016. You can see this ratio started to improve. The gold stocks had a great rally. And notice how once it broke this trend line, that was right in August of 2016, right as gold had already peaked. It was just starting to roll over. This was a good confirmation that gold was going to have a decline. Here at the beginning of this year, broke, bingo, nice big rally. That's a 25% or so rally in the gold stocks. And then again, it starts to weaken, and it has continued. So even though when gold was rallying from 1120 in July,
the shares underperformed.
They underperformed, and it's so to me that was another tell that gee, I think this breakout in gold is going to be a false breakout. And then lastly, silver, never exceeded its April high. So divergences between gold and silver on an intermediate basis are really, really important. And in this case, it was a negative one. When you added up the positioning in the gold futures, the lack of strength in the gold stocks, and then the silver diverging, all those things made me believe that breakout was a false breakout and we were going to see gold break below. And, so far, at least that's played out. So sorry if we run a little long, guys.
Oh, no problem. It was a great presentation, Jim. In fact, someone says, Mr. Jim Welsh, what a great teacher. Very clear point. So,
well, thank you.
I want to thank you so much for edifying our community today.
Well, Dale, thank you very much for the invite. I appreciate it. I love, obviously, like I think everybody in this room, we love looking at charts. We'll try to figure this stuff out. To me, the cool thing here is we're matching our minds with some of the greatest minds in the world in terms of focusing on markets and stuff. And so, to me, that's the ultimate warrior, is to understand that, respect that, and then constantly, day in and day out, put forth the effort to learn a little bit more every single day. 5 years from now, all that incremental effort makes a huge difference. So all I can do is offer words of encouragement. As I said at the beginning, learning more about intermediate term trends, I think, can be very helpful to provide an extra level of conviction when you start taking trades that might be based on short-term stuff, but to be able to maybe increase size and then hang with the trade and letting a winning trade win. So again, Dale, thank you.
Helps you with your biases. And Jim, looks like you're making a nice offer. You're offering all of October for free?
Yep. The monthly letter will go out in the first week of October. And that's where I try to, talk about what's going on fundamentally. So the monthly issue is, 90% fundamentals. And then the weekly technical is just the opposite. It's 90% technicals, but I do try to talk about some fundamentals, that have maybe taken place in the prior week that obviously have bearing on various markets, and with Fed meetings and so forth taking place, ECB coming up, those are kind of the things that I try to interweave with the technicals.
Well, good hunting, my trading warrior brother and very good friend. And everyone, I love Jim. I look forward to reading Jim's stuff. I would Jones without it. I've been reading it for, 25 years or so. So write down his email address to get your trial, jimwelshmacro@gmail. And you could follow him on Twitter at jimwelshmacro. So thank you for your time today, buddy.
Thank you. Appreciate it. And thanks everybody who tuned in. All right. Good trading. Thank you.
All right. Thank you, Jimmy. All right, everyone. That's a wrap. Remember that we only have about 4 days left so that you guys could get into the trading room, right? Because right now, Face is going to close, right? So where are you going to go? Where are you going to go now that Face is going to close? Here's where you go. Right here. To hang out with 51 great traders in our trading room. It takes a 6-month commitment or 6 one-month subscriptions to be in here. So look, all kinds of trading calls happening in here for the duration of the US session. I've stopped in during Asia sessions, and there's some people in here. I haven't been up in the middle of the night to see what's happening in Europe, but I just want to call everyone's attention to this one last time. This week, very nice value that the partners at ForexAnalytix are offering. Buy 1 month, get 1 free. Buy 6 for the price of 4. Buy 12 for the price of 8. And you get to leave Face and go into our trading room and share your ideas. And if you're looking for a place to become a trading ace, you need to hang out in Ace and in Face. And above that, guys, good pip hunting. But above that, don't just count your pips, count your blessings. See everyone for TGIF. I have Mickey Fulp tomorrow at Mercenary Geologist. So for all you metalheads, and I'm not talking about Iron Maiden, Mickey was real bullish copper when everyone hated it a few years. So it's going to be great to talk to Mickey tomorrow. Enjoy the rest of your fall day, and we'll wrap it up TGIF tomorrow. Adios, everyone. Oh, and a great song. Yes, Velu, have a great birthday. And we'll see everyone tomorrow. Thank you, all you viewers at investing.com. It's our mission to build up and edify traders every day. Hope we added value to what you're attempting to accomplish as a trader. Adios, everyone.